Just like some states have a requirement that there must be a par value, some states have a requirement, state of Texas is one of them, that you're not allowed to distribute cash dividends if you have a negative retained earnings. That is not the case in all 50 states. I can only speak to the state of Texas. So when you get to your problems class, sometime in your future graduate class, it's the capstone of the graduate program. There's a midterm on there, and I'll warn you right now, the midterm problem has a negative retained earning. And very few students, I'm hoping you guys will remember, very few students realize that you're not allowed to distribute dividends. So because there's a dividend in the problem. So you are expected to notice that and say, nope, can't pay these, don't have a positive retained earnings balance. So, all right. Okay, so cash dividends is the most important part. There are 4 dividend dates. The board of directors meets and declares a dividend. At that point is when you're going to make the journal entry. A debit to retained earnings, lowering the retained earnings by the amount of the dividend, and a credit to dividend payable, increasing a liability. So the net effect to the asset side is 0 at that point. There then is a date of record. And date of records are to give the, nowadays it's kind of a moot point because it's all electronic. The date of record is when will the shareholders who own those shares of stock have the dividends. Now, when you look at the historical record, the price per share of a stock, what happens on the declaration date is the stock price bumps up by the amount of the dividend. So if it's 80 cents per share, the price will close that day up 80 cents a share, assuming nothing else happens in the news. Then, on the date of record, the stock then becomes ex-dividend. And they'll put a little X next to the price in the pages out here. And on that day, the stock will drop off by the dividend. So in other words, if you buy it from the shareholder that owns it now, if you buy that share of stock after the dividend was declared, you're in essence paying the shareholder for the dividend because it's built into the price. Just like when we bought a bond, you recall back in chapter 14 when we were selling a bond mid-interest, we would pay the bondholder for the interest that has accrued between the last interest payment and the day that we bought the bond. All right? It's the same with dividends. And remind me when on Thursday or next Tuesday, I'll pull up a historical on Boeing, because Boeing pays dividends twice a year like clockwork. And you'll see it. You can see the daily price of the stock bump up and then bump back down. You can track it. It's very obvious. Okay? And then there's the date of payment. So there's no journal entry needed on the ex-dividend date, and there's no dividend on the date of record. Only the declaration in which you create the liability, and then the date of payment where you pay the liability. So at that point, that's a debit to dividend payable and a credit to cash. All right? So the ex-dividend date is the stock stops selling with the dividends attached. All right? So here's the flow. Date of declaration, you're reducing retained earnings. No journal entry needed for date of record. And then date of payment, you reduce cash or the whatever asset you're distributing in the case of a dividend. So here's a record, you know, on November 22nd, we're going to pay a total of $65,000, $25,000 to the preferred, stockholders and 40 to the common stockholders. They're payable on December 15th for shareholders of record of November 23rd. So the date of declaration has this: a debit to retained earnings for the total $65,000, credits to dividend payable on preferred and dividend payable on common. And then nothing happens other than a memorandum as to who actually holds the stock as of November 23rd, and that more than likely is when the dividends begin selling ex-dividend. And then on December 14th, we wipe out the liability and credit cash. All right. We'll talk about this later. I'm not going to worry about this right now. All right, the other part of earned capital is other comprehensive income. We've already talked about other comprehensive income in this course when we talked about unrealized gains on available for sale securities, whether they're bonds or stocks. You're going to write up or write down to their fair market value these securities at the balance sheet date, but they're not trading securities. So management is not intending to buy and sell these securities for short-term gain. It's all based on management's intent. So what we're doing here is we're taking it to other comprehensive income. The other aspects is converting financial statements of a foreign subsidiary. You have gains and losses on financial transactions when you're buying and selling goods and services internationally. That's an income statement item. But if you're translating a foreign subsidiary's financial statements, their balance sheet, into U.S. cash, the difference is the gains and losses based upon transaction, the foreign currency exchange that fluctuates on an annual basis. That is another component of other comprehensive income. And you'll get this when you take advanced financial reporting at the graduate level. It's 6340 in this, and consolidated financial statements is really the bulk of that course. Derivatives for cash flow hedges, and then gains and losses on pension plans with prior service costs. That's another aspect of other comprehensive income. All right, so this is the bulk of this one. Earnings per share. Earnings per share retains its flavor. So if you have a multi-step income statement that has a calculation for earnings from continuing operations and then an aspect from discontinued operations, you need to compute the earnings per share in those different categories and report them. And it also, up until next year, because you remember at the beginning of the semester here, I told you the extraordinary gains and losses are going away. There are no longer going to be any extraordinary gains or losses under U.S. GAAP. They've decided to do away with them. But if you're doing 2014, and because it becomes effective for years beginning December 15th of 2015. So for most companies, even their 2015, you'll still have an extraordinary gain or loss. 16 and beyond, no. So you may see that in there. But so you need to calculate that by flavor in earnings per share. Earnings per share, quite simply, is net income that is attributable to common shareholders divided by the weighted average number of common shares. All right? So if you have the same number of shares all throughout the year, that's easy. But that doesn't happen very often because corporations continue to sell additional shares of stock on an annual basis. They also give stock dividends, or they do stock splits. All of those will affect your weighted average number of shares, and we'll talk about how we calculate that. So what's attributable to common shareholders? Well, it's just simply the net income minus any preferred dividends that are paid. Okay? So if you have a preferred stock and the preferred shareholders got declared a dividend during the year, then you subtract that out of net income for your numerator. The denominator is this weighted average that we'll talk about here in a second. All right? So, in a simple capital structure, this is, you just have some common stock, possibly you have some non-convertible preferred stock, but you just have two simple classes of stock. The preferred stock is non-convertible, is the important component. So what is a convertible stock? Does anybody have an idea? From the term. A convertible stock is convertible into common stock. Just like a convertible bond, and we talked about that when we were back in chapter whatever, 14 or 15, 14. A convertible bond is convertible into shares of common stock. Okay? That makes it a complex capital structure. If you have a simple capital structure, you only have to calculate basic earnings per share. That's the net income attributable to common shareholders, the net income minus any preferred dividends, divided by the weighted average of the common shares outstanding. Under a complex capital structure, you have to do two calculations. And that's why we'll spend a second day doing problems in this class. Is that the second calculation is a fully diluted earnings per share. What would your earnings per share look like if we converted everything to common shares that could be converted to common shares? That's all stock warrants, stock options, convertible preferred stock, and convertible bonds. So if on January 1 of the current year, everyone who could have exchanged their warrant, option, preferred stock, or bond into common shares, what would the earnings per share look like? This falls into the conservative aspect of accounting. We want to show the world how bad could it get if everybody who could have a share of common stock actually went out and did so. At that point, what would the earnings per share look like? And why is earnings per share so critical, so important? I mean, Coca-Cola is releasing earnings today. The expectation on the street is Coca-Cola's earnings per share is going to go from 42 cents a share, or 44 cents a share from last year to 42 cents a share for 2014. 2 cents a share. We'll go look between now and Thursday as to what happens to Coca-Cola stock today. I'm expecting it to crater, especially if they come out with a 41 cent a share rather than 42, which is the expectation. Yeah. Yeah, why is earnings per share so focused on? Yes, it shows a direct relationship with the earnings and the number of shares that are outstanding. But why is that critical?
Because whatever the percentage comes out to be, the decimal it shows for every share put in, how much earnings coming down to. That's as far as we want to find it.
There's another component. There's a price-earnings ratio. It's known in finance as the multiple. All right, have you heard of that? It's the number of times earnings, the earnings per share, that the price is. All right? And depending upon industry, there is a multiple that is standard. Okay? In finance, you'll see that the price of a share of stock should be the present value of all future earnings. All right? That's a theoretical thing. And okay, how do you determine what all future earnings are? Who knows? Okay? So, but it is. And when multiples start getting too high, the stock gets nervous. And you'll start seeing analysts out there issuing sell orders. In the tech industry, you can see multiples of 20, 25. In the old brick and mortar, you normally see them in the 10 to 15 range. I think Boeing right now is selling at a multiple of, I don't know, 12, something like that. Okay? So it's critical. This is the most important. If you look at a annual report, the earnings per share is going to be on the first couple of pages, if it's good. It'll be on page 15 or 16 if it's bad. This is what they lead with. The little blip that I got from the Wall Street Journal this morning on Coca-Cola's earnings, and it was only a little paragraph that I got, a little message that was sent to me on my iPhone. That's all it said, was that Coca-Cola was expecting a 42-cent per share earnings per share, down from the prior year of 44, down 2 cents. But that was all the news. And then when on the page of the Wall Street Journal, when I went and started reading that this morning online, that was one of the lead stories. Coca-Cola's earnings are coming out today. All right? So the reason we do this, and the reason we do it in two separate areas, is because of the critical nature of the calculation. The earnings per share is arguably the one that analysts focus on the most, and that's because of the multiple. If you go, once again, to, and I'll do this either Thursday or next Tuesday, if I go to any site on MSN Money or on Yahoo Finance, if I go to any publicly traded company, the multiple will be on the first page. It's in the block of statistics that they show you. The number of shares outstanding, what the current price is. It's normally listed right underneath the current price. You'll see earnings per share and you'll see the multiple, the price-earnings ratio. Okay? All right, so that's the reason this is so important. So, how do we calculate the denominator? The weighted average number of shares. You take the number of actual shares outstanding for any individual period throughout the year. So, what did they start the year with? And then when was the first moment that the number of shares changed? And a change could be they've issued new stock, they've gone out and bought some Treasury stock. That's going to affect the number of shares outstanding. If they go out and buy their own stock, that affects this calculation. And then what do you do with stock dividends and stock splits? There's special rules associated with that. You multiply it by the fraction of the year outstanding, and that gives you a weighted average number of shares outstanding. You do that for each and every period in which the stock number changes. So if they had 2 stock sales, then you do it at least 3 times. You've got the stock that they started the year with, after the first sale, and after the second sale. If they have 2 stock sales and a stock buyback, Treasury stock, then you do it 4 times. You do the number of shares that they started the year, then the new, after the first sale of new stock, and then the second sale of a new stock, and then you do a 4th calculation like this, actual shares outstanding times the fraction, in order to calculate. And then you add up this column, this weighted average, and that gives you your denominator. Okay? So let's look at an example. 15,000 shares outstanding at the beginning of the year. March 2nd, it sold 2,700 shares. On July 3rd, it issued another 3,300 shares. And then on December 1st, it bought back 600 shares of Treasury stock. So that was the calculation. All right, those were the transactions that affected common stock throughout the year. So, January and February, they had 15,000 shares. That's 2 months. 2/12 of 15,000 shares is 2,500. Then, on the beginning of March, they sold another 2,700 shares. That brings the total shares to 17,700. That's going to stay the same until the beginning of July. So that's 4 months. March, April, May, and June. 4/12 is 5,900. And then 5/12 of, they sold another 3,300, bringing the total to 21,000 for 5 months, 8,750. And then they bought back 600 shares at the beginning of December. So 1/12, they had 20,400 shares. So the denominator for this particular company is $18,850. Okay? Yes?
No, I didn't get the fraction of the year.
Okay. We had 3 transactions. All right?
Yes.
March 2nd, July 3rd, and December 1st. Okay? So, January and February, before the first stock transaction of selling 2,700 shares, that's 2 months. That there were 15,000 shares outstanding. That's what we started the year with. Okay? So 2/12 of 15,000 is 2,500 units. Okay? Shares of stock. Then we sell 2,700 shares at the beginning of March, March 3rd. Now we have 17,700. Nothing is going to change until we get to July,
So you count March,
April, May, and June.
so that's
4/12. Okay? Because this all adds up to, all the numerators here add up to 12. So you'll wind up with 100% of the stock outstanding. Okay? Yes? Does everybody else understand that? Okay. And you just round it to the closest whole month. So, stock dividends or stock splits. For earnings per share, this is once again to make it simple, we assume that all stock dividends and stock splits occur at the beginning of the earliest comparative period. The reason for this is a stock dividend. Let's say they're going to give everybody who owns common stock a 10% stock dividend. So if I own 10 shares, I get 1 extra share. But my pro rata ownership of that corporation has essentially not changed, right? If nothing else happens throughout the year, they don't sell any new stock to outsiders, they don't buy back any Treasury stock, if nothing else happens, then really nothing happened with a stock dividend or a stock split. It's just that with a stock split, rather than 100,000 shares of stocks outstanding, there's now 200,000 shares. All right? So if we're going to do a comparative, the prior year and the current year, we're going to release earnings, and it is very common for financial statements to have at least 2 years. Oftentimes they'll do 3 or 4, but at least 2 years on a financial statement. So for the earnings that are starting to roll out now that it's February, during the earnings release period between now and the middle of March, when everybody releases their 12/31/2014 earnings, it will show 2014 and 2013. Okay? If everything stayed the same, other than a 2-for-1 stock split, and you didn't use this rule, what would happen to the earnings per share from one year to the next? Let's say you do a 2-for-1 stock split in December of 2014. You started the period January 1 of 2013, the comparative period over the 2-year period. You started the year with 100,000 shares of stock. You now have 200,000 shares of stock. If you didn't use this rule, what would happen to earnings per share? It would drop, right? Well, nothing else happened. Everybody who owned 10% of the company still owns 10% of the company. So why make the earnings per share go in half? So what you do is you go back and you recalculate earnings per share to that lower level even in 2013. All right? So, new example, 5,000 shares of common stock that are outstanding. On December 10th, you had a 2-for-1 stock split. So now you've got 10,000 shares. Then in 2014, on June 1, we sold 5,000 shares. On August 9th, we issued another stock dividend, 20%. And then we sold another 2,000 shares of common stock. So that's the transactions. A 2-for-1 stock split in 2013, a 20% stock dividend on August of 2014, August 9th, and then 5,000 shares June 1 and 2,000 shares October 1. You make the assumption, even in 2013, that both the stock split and the stock dividend occurred at the beginning of the year. So for 2013, you really had 12,000 shares of stock. Does that make sense? Once again, if those were the only 2 stock transactions that occurred during the 2-year period, then the earnings per share will stay consistent from year to year. Nothing will change.
Would you get 120%?
That's the 20% stock dividend. Yeah. If you own 100 shares, when you get a 20% stock dividend, now you have 120 shares. Okay? And then, how does this affect? We have 10,000 because the stock split has actually occurred now, because it occurred in 2013. Now, for the January through May, because the first sale of 5,000 shares of stock doesn't occur until the beginning of June. So for 5 months, we have the 10,000 times the 120% for 12,000 times 5/12 or 5,000 shares of weighted average stock outstanding. Then, in June and July, we have until the beginning of August is when the stock dividend occurred. And what I'll do when I do problems, I'll combine these 2 months, because really you've already taken into account the 20%. So you might as well just take this by 4/12, because that's all that has changed. You can see the assumed shares outstanding is 18 and 18. So you could have done 4/12 here and done 6,000 rather than 2 separate calculations. But that's what's going on here is the stock dividend, the 20% stock dividend. So it changes from 15,000 to 18,000 because 15,000 times 20% is 3,000 shares of stock. All right? Then we sell another 2,000 shares of actual stock. So now the stock goes to 20,000, and that's the remaining 3 months of the year for October, November, and December. So 16,000 is the new weighted average share, equivalent shares. Okay. All right, so basic earnings per share calculation. We have net income of 14,000. An extraordinary gain of 3,600 is included in that amount. So really, net income from continuing operations is 10,400, and then total net income is 14. We have a preferred stock 8% at $100 that actually paid its stock dividend for the year. There was no changes in preferred stock throughout the year. The preferred dividend was declared, and so it's $8 per share for 300, so it's 2,400 is the dividend. Then we had started the year with 2,000 shares of common. We issued 500 for cash. Then we did a 2-for-1 stock split. Now we've got a total outstanding of 5,000. And then we issued an additional 1,100 or additional 1,000 on November 1. So net income attributable to common shareholders is $11,400 because there was $30,000 in the preferred stock account. That's from your homework last time. That was the legal capital. Did everybody figure that out for homework? The legal capital is what's in the par value accounts. Okay, it doesn't include the paid in excess over par. Yes, sir.
As far as the common stock, if it had no par value,
if it's had no par, you still have all of that is now.
the initial issuing price was, correct?
Yes, correct. If it has no par. The only time you have it is when it's got a par value or a stated value. Some stocks have a stated value rather than a par value. So, all right, and that's what makes up the legal capital. If it's truly a no par stock, then 100% of what you issued it for goes into that. All right? Okay, so the weighted average is that there's 2,000 times the stock split, or 4,000 times 3/12, that's 1,000. Then we sell 500 shares, still have to take into account the stock split, so that's 5,000 times 7/12 for 2,917. And then we have the stock split has actually occurred, so we really do have 5,000 shares out there, and now we sell another 1,000 shares. So we've got 6,000 total outstanding times 2/12 or 1,000. So the basic earnings per share calculation is the 11,600 divided by the 4,917 weighted average for common, or $2.36. But remember, we had an extraordinary gain here. So we need to put this into the calculation as to how much of it is income before extraordinary items and net income. So 236 is the total basic earnings per share. You take that 3,600 extraordinary gain and divide it by this same 4,917 weighted average for common shares, and you get 73 cents. Subtract that and you get the income before extraordinary items.
There's no more extraordinary items.
I know, but there is as we speak. So if you guys were to take the CPA exam sometime between now and the end of, they're probably going to still include it even in 2016. But beyond that, which none of you are going to graduate before then, so yes, you can ignore this. Let's call it income from discontinued operations, all right? It would be the same calculation. If income from discontinued operations was $3,600, you'd have to do the same thing. You have to split it and report it by flavor, is the point, even though there is not, as you correctly stated, an extraordinary item anymore. Okay? You have to do it by flavor. Does that make sense? All right, basic earnings per share. This is what we'll focus on Thursday. Doing these kind of, and mainly doing the denominator calculation, because once you do the denominator, the rest of the math is pretty simple. Okay? So you just subtract the preferred dividend and divide it. All right? Okay. Fully diluted. Now bear with me here, because this is where everything goes off the rails and every time I've attempted to teach this. And I'm going to show an example here in a second of the calculation. Okay? Fully diluted earnings per share, as I said, is that if everyone who could buy a share or convert an existing security, whether it's a preferred stock or a bond, to common shares, did so. However, in keeping with the conservative nature of accounting, we only include those calculations if it is dilutive, meaning it drives the earnings per share down. Now, how could it not be dilutive? Well, with stock options and stock warrants, they're all dilutive. So you always include all stock options and stock warrants. And we'll talk about how you do that here in a second. You use something called the Treasury stock approach. Preferred stock and bonds affect both the denominator and the numerator. It affects the denominator because a preferred stock is convertible into so many shares of common, right? So it's going to affect the weighted average number of shares because now you have more common stock. With me so far? So how does a preferred stock that gets converted into common stock affect the numerator? Here's the tricky part. What's the numerator? Net income attributable to common stock. So how does a preferred stock that got converted affect that numerator? Think it through. Because what do you deduct from net income to come up with the amount that's attributable to common share? You deduct the preferred dividends. If it had been converted, there are no preferred dividends. Right? Does that make sense? So there is an effect to both the numerator and the denominator. You have the preferred dividends that are declared and paid throughout the year, plus you have how many shares could all these preferred stock be converted into. All right? So that's preferred. How does a bond affect the denominator and the numerator? If all the bonds were converted to common stock, what would go away? What do bonds pay? Not dividends. They pay interest, right? Interest expense is included in net income, right? But it's included after taxes. Because interest expense lowers taxes, right? It's a tax deduction. So the preferred dividends do not. They're not deductible for tax purposes. So preferred dividends, you just use 100% of the preferred dividends as its impact on the numerator. But for interest expense, you have to deduct, you have to make it after taxes. You have to multiply it by 1 minus the tax rate. Okay? And we'll be doing lots of these problems. I'm going to show you an example today, but we'll be doing lots of these problems a week from today, next Tuesday, because that's when we'll focus on fully. So, stock, share options, warrants, convertible preferred stock, and convertible bonds, any participating securities, different classes of common stock are referred to as potential common shares if they could be used to acquire shares of common stock. So if you have a complex capital structure, you're required to present both basic and fully diluted earnings per share. Excuse me. So the earnings per share for fully diluted is after all potential common shares had been converted if it reduces earnings per share. And it may not. So how do you do it? You compute the basic, then you individually develop a ranking of each convertible stock or bond and calculate its impact. So for a preferred stock, you would calculate the numerator for this calculation, the impact calculation, would be just the dividend paid. You would divide it by how many shares could it be converted into. Right? Because it'll tell you in the problem. It's $100 preferred stock, $100 par preferred stock. There's 3,000 shares outstanding. Each share can be converted into 10 shares of common stock. That'll be a typical convertible preferred. All right? So the numerator is the dividends, which let's say is $3,000, and the denominator, or $30,000, and the denominator is the number of shares. So if there was 300 shares of preferred outstanding, each one could be converted into 10, that's 3,000. So that's the impact. With a bond, you have to take the interest expense multiplied by 1 minus the tax rate, because it does lower taxable income, and then divide it by the number of shares that it could be converted into. You then rank these impacts, the lowest to the highest. So for simplicity, let's say you come up with an impact of $1.20, $1.50, $2, and $2.50. Okay? You start with the $1.50. You add the numerator, whether it's the preferred dividend or the interest minus 1 minus the tax rate, to your basic earnings per share numerator. And then you add the denominator, how many shares could it be converted into, to the weighted average shares. And then you recalculate earnings per share. You compare that new earnings per share, that new diluted earnings per share, to the next security on the list. If the impact is less than the current diluted earnings per share, you include the numerator and denominator of that new stock or bond. And you keep doing that until the diluted earnings per share is lower than the next impact. In other words, if the next security, say in our simple example, our next security is $2. That's the third security, because we had, or the $2.50. We had one at $1, we had one at $1.50, one at $2, and one at $2.50. So if the next one is $2, our current diluted earnings per share, after we included those first two securities at $1 and $1.50, is $1.89. If you add that $2 impact, that $1.89 will go up. And we don't want that to happen. We stop. God, the furrowed brows. You're all just looking at me. It's going to make sense, trust me, when I start doing problems. All right, let's just look at a quick example here, and then I'll show you, I'll show you what the midterm option is. Stock options and warrants are always dilutive because they have no effect on the numerator. So they are always going to drive down the earnings per share. So if the problem gives you stock options or stock warrants, you have to do that calculation first. That's your new baseline diluted earnings per share before you start looking at convertible securities. We use the Treasury stock method. What the Treasury stock method is that you assume that all of the options and all of the warrants are exercised. Okay? Stock options and stock warrants have a strike price. You can buy one share of stock at $30. That's what we were doing in the last chapter when we were talking about compensatory stock option plans and performance-based stock option plans. Remember, they always had a strike price. They could buy the stock for $30 or $45 a share. You use those proceeds to go out into the open market and acquire all of the shares of stock that you could at the average market price throughout the year. The net of the two. So if there's 100 stock options, you have 100 new shares, but let's say based upon the average market price, you could go out and buy 90 of those shares back as treasury stock. The increment to your denominator is 10. The difference between all the shares that you could issue less how many could you buy back with the proceeds. Okay? Does that make sense? That's the easy part of all this. So I'm hoping you grasp that. Problems next Tuesday. All right. Here's a quick example. Exercise for stock options under a compensatory share option. Employees could buy 1,000 shares of common stock for $18 per share. The average market price for that same stock throughout the prior year was $25 a share. We also have unrecognized compensation costs, because remember we had compensation costs being recognized each year based upon the vesting of the stock options of $2 per share. So you take the 20,000 proceeds, which is the compensation plus the strike price, the $18, divide it by the $25 per share, you get 800 treasury stock bought back. Your denominator goes up by 200 shares. You issue 1,000, you can get 800 back. You have a net change under this compensatory stock option of 200 shares. All right? All right. Fully diluted. We've got 4 different convertible securities. Almost done. 4 different convertible securities. We have a preferred stock that had dividends paid of $5,400, and they were convertible into 3,000 shares of stock. We had we had a second one, C, an 8% convertible preferred stock that paid 8,000 of dividends throughout the year, which was convertible into 5,000 shares of stock. They had a 10% convertible bond that paid interest net of income taxes. They made it simple for you here. When we start doing problems, we'll just compute. We'll know what the face value of the bond is. We'll compute the interest, whether it has a discount or not, because discounts and premiums affect this calculation. So when we're getting into the details of it, we'll have a couple of bond premium and a couple of bond discounts that you have to include. So this simple example is that it's net of taxes, $4,800 in interest, and on this one, $6,300 of interest net of taxes. All right? So what's the impact? Take the $5,400 preferred stock dividend, divide it by the 3,000 shares that it could be converted into. That's $1.80. Take the interest of $4,800 on the bond, divide it by the 1,920 shares of stock. That's $2.50. $1.60 and $2. So that's the impact of each of the individual securities that can be converted. All right? Rank them. What's the most dilutive? The $1.60. That second class of preferred stock. The next dilutive is the preferred stock A. And then we go to the bond, and then lastly the last bond. So, if you have, and I don't have a calculation, that's what I'll show you here in a second. So you keep increasing the numerator and the denominator till such time that your new revised tentative diluted earnings per share is now lower than the next impact. Okay? So let me show you a very, very quick example, and then we'll be finished. This looks familiar. This looks like one of my midterm exams. Yes, it's the midterm question. From the master, it will change. There are 4 stocks. It's very similar to the example that we just did. 4 convertible securities. There's 220,000 of 10%, $100 par cumulative preferred stock. Each share is convertible into 5 shares of common. Then there's a couple of bonds. The income tax rate is 40%, and its net income was $88,000. And then it had these stock transactions that occurred throughout the year. They had 10,000 shares at the beginning of the year. They issued a 10% stock dividend, and they also issued a 2-for-1 stock split. And then they sold on July 1, 1,500 shares, and on December 1st, they reacquired 15,000 shares. So this is the weighted average calculation. We'll worry about that later. This is the impact. All right? So our basic earnings per share is the $88,000 less the preferred dividends from stock A and the preferred dividends from stock D. All right? So those are the 2 preferred dividends. That is a net income attributable to common shareholders of $49,500. The weighted average was $22,250 for a $2.22 basic earnings per share. All right? So that's where you start. Then, what's the impact? Well, the impact on the preferred dividends is just the amount of the dividend divided by the number of shares that it could be converted into. So the impact for the dividend are $2.20. Those are the 2 preferred stock. For the bond, you take the interest rates of the bond and you multiply it by 1 minus the tax rate. Because you're dealing with net income. Net income is after taxes, so you need to make the interest after taxes. So these 2 divided by their individual number of shares that they could be converted into results in $1.27 and $1.50. So the most dilutive share is B. All right, that's $1.27. If you take the numerator and denominator, which was, you can see up there at the top, 49,500. Let's scroll this up just a little bit. 49,500 plus this is the 19,000 times 60%, 11,400. And then the 22,250 plus the 9,000, the number of shares that particular bond was convertible into. Add those to the top and bottom. You now have a new numerator and denominator and a new earnings per share, diluted earnings per share of $1.95. Okay? What's the impact of the next stock? It's the other bond at $1.50. What do you know already based upon this first round of calculation? Are we ever going to get to the preferred stocks? No, because the preferred stocks is $2 and $2.20. You're never going to use those in this calculation because they would be anti-dilutive. They would drive the earnings per share price up. And sure enough, I'll just show you down here. When we add in the next round, which is security B and C, we get $1. We go from $1.95 to $1.91. If we had included the first preferred stock, because we're now at 65,700 as a numerator and 34,450 when we included the 2 bonds, we then wind up with $1.93. It's anti-dilutive. We never get to that. And you knew that because your fully diluted earnings per share of $1.91 is now lower than the next impact of $2 per share for that preferred stock A. That's how it works. It's not complicated. Yes? By the time a week from now, you'll all go, oh, that's what he means. This makes sense.